Hey, good evening. Brian Hoops from Midwest Market Solutions and our Market Insider TV. WASD report webinar. This is in place of our usual closing TV segment, and we're going to look at the report and its implications. And it's certainly bullish for corn and soybeans. Just nothing to report. It can't even be considered neutral on wheat because there's nothing to report about the wheat market. So corn and soybeans is the focus, and it was wildly bullish, I thought, for both of those commodities, more so for the soybeans. Make sure you follow us on Twitter at Midwest Markets for the latest market information, and follow our website, MidwestMarketSolutions.com, where we post daily Insider TV videos and newsletters, commentaries, all kinds of information there at our website. We have 11 licensed brokers, 10 offices around the Midwest, all different states represented, and we clear through R.J. O'Brien. We offer discount and full service brokerage firms, trading platforms, hedging programs, as well as our newsletters and audio and video commentaries. So a lot of services offered to our clients. Just find one that works for you. Let us know how we can help you out. All right, taking a look at the report numbers today. So production was one of the key things that we were looking at, and yields for corn came down sharply compared to last month, 175.8, and yields for soybeans at 50.7. 16 states saw a reduction in corn yield. Biggest loser was North Dakota, 15 bushels per acre. Iowa dropped 2, and Illinois dropped 5. I think it's curious that Iowa only dropped 2, while Illinois dropped 5. We may see a little bit more revision to the Iowa numbers, but in the December supply and demand report, no production changes. That comes on the final numbers. And, the saying, small crops get smaller. We've been smaller last couple months. We're probably going to get smaller into the final report in January. That means prices likely to work higher until that time frame. Production overall, 14.5 billion bushel corn and 4.17 for soybeans, below the average trade gas. Now, if you look at this column here, this is last year. Both of these numbers well above last year, but far cry from what we saw forecasted earlier this summer. Ending stocks, again, a far cry from what we saw forecast earlier this summer. Remember when the pandemic started in March and the country was shutting down and ethanol plants were closing? We're talking corn ending stocks 3.5 to 3.7 billion bushels. Now we're at 1.7. So this is below last year, below the previous number from the USDA, below last year, bullish. 1.7, that's not super tight, but we'll look at stocks to use ratios here in a minute, and it's friendly. Soybeans, this is pretty friendly, 190 million bushels, and I think it's going to get tighter yet, and I'll tell you why in a minute, well below the average trade gas. 100 million less than last month. Last year, we were at 523. There was some talk at 900 million bushels at one point. And so we've had over a $2 rally in soybeans trying to ration some of this crop, and I don't think we're done yet. We had a huge rally today. We're likely to see extended gains into the weekend. We might see some rounds of profit taking, but there's going to be people buying into this market yet, and I think they are justified in doing so based off of these numbers. As I mentioned, not much change for the wheat, 877 ending stocks. Previously, USDA was 883, so you lost 5 million bushels, one below the average trade gas. It's down from last year. That's encouraging. All these numbers are below last year's levels, and that's certainly encouraging. We'll take a quick look at world ending stocks. Soybeans is down, corn is well down from last month, and wheat is just a little bit lower. And compared to last year, we are lower than last year as well. So it's not so much that the world has huge supplies. We need to replenish some of these supplies. We have had back-to-back years of corn and soybeans where yields have been reduced just a little bit, and that's enough with strong demand trends to really cut into our ending stocks. Chinese corn imports, this is going to be key. Right now, the USDA says 13 million tons of corn. Previously, they were at 7. They didn't change soybean imports at all. That's interesting from the standpoint that's reflected in the balance sheets. The USDA Ag Attaché over the weekend talked about corn exports to China being nearly 20 million. So that means they have another 7 million to go based off of what the USDA is forecasting. That is going to be huge, and I think that's the reason why you need to have some upside potential left in this corn market. Let's look at a couple breakdowns commodity by commodity. As far as our planted acres, no change there. Now, they may change this in the January report, harvested and planted acres, but this is getting closer to the final yield estimate. We're at 175.8. down 2.5 bushels. Production slipped by 215. They lowered demand here in the feed and residual category. We're going to feed less corn, and that makes sense as you get to $4 corn. Nobody wants to feed $4 corn. Exports, we're going to export a lot more corn. They had 300 million bushel jump. They could easily jump this another 300 million bushels because of that previous slide that we talked about. Corn exports here to China, they've got it at 13 million bushels. If China does end up taking 20 like the attaché forecast, they're going to have to bump this number up even more than 2.65 billion. Ending stocks at 1.7. This is getting tight, and notice the big jump in cash prices, up 40 cents to $4. If we look at a breakdown on the balance sheets, in this column here is the USDA for this marketing year. Carry out at 1.7. I'm a little bit larger than that, and for just little reasons here. I think you could increase a little bit or decrease a little bit of ethanol usage yet. They may be a little bit too high. I think feed and residual, they're a little bit too low, so I have a little bit more usage there. Yields, I'm thinking we're going to come down in January, but exports, I have 100 million bushel less. They're already forecasting a high number. We'll have to see if China continues to be an aggressive buyer like the attaché thinks to hit that 2.6. But if they continue to be good buyers, yeah, we could bump this export profile up. But look at the exports compared to last 7 years of history. This would be a new record that we have as far as corn exports. The best year was 17 and 18 at 2.438 billion bushels. This is well above last year, 900 million bushels compared to what we were a year ago. So this is already anticipating a huge jump in exports. I think they may be overvalued just a little bit. If not, this may shrink to 1.5, 1.6 billion. And if that's the case, we're going to see higher prices. Our stocks to use ratio of 11.5%. That's the tightest since going back to this year. First time we've been under 12% since this time frame, 12 and 13, 14 marketing year, and that's when we had stocks quite a bit tighter than where we're at now. So we've got very good usage, 14.8. That would be like a new record. Best year was 14.8 in 17 and 18. This forecast, I think, is friendly for corn. We're using more corn than what we are producing. So overall, that's bullish. For soybeans, minor changes here. Yields and harvested acres down 1.2 bushels per acre. So that's a positive. Almost 100 million bushel loss in production. And strangely, no change in exports. They're at 2.2 billion. No change there. They just increased seed and reduced residual. So not much change at all to total usage, only 3 million bushels. And that's how they came up with the 100 million bushel loss of soybeans here. So let's take a look at how this fares historically. This column is the USDA number. My numbers are to the right, 50.5 bushels per acre. I think we maybe still a little bit overstated on yield. I think the exports could improve, maybe another 50 million bushels. And crush has also been record large, maybe at least another 5 million bushels. They didn't change either one of these numbers, and I think they certainly could. If you look compared to last year, 1.67 was our exports, so we're already higher than that, and this would be a new record. The previous records were back in this time frame, 2.166, 2.129, 16, 17, and 18 marketing years. But if they start jumping these export numbers too much, we're going to start talking about having to really ration soybeans. Ending stocks could be dropping below 100 million. I have them down to 125 due to a little bit better export profile, a little less production. So I think we're going to be flirting with numbers back in this area here rather than in this area where we're currently at. We're currently in this 14, 15, 16 area as far as stocks to use ratio, ending stocks numbers. I think we probably are going to tighten this up over the next 2 months. 125, maybe less than that. The tightest we've ever been was 92 million bushels. Stocks to use ratio 2.7. That's where I have the stocks to use ratio at 2.7. So we're going to tighten this balance sheet up in soybeans a little bit farther, and maybe corn as well. I put this slide on last month. I'm going to leave it on here because I'm trying to get a point across. Here in October, this is 2003, the fall of 2003, for the spring of 2004. and 4. This is the July contract. We had the same type of setup market. And I've gone on radio and TV talking about this. This market was inverted in 2003, meaning the front month was higher than the back months, telling producers to sell the crop and re-own it. That's what we've been preaching producers to do. And we started here in in this September October timeframe. We started a rally, and that rally continued through the winter months, and really got excited in February and March, all the way until, notice the planning timeframe, April and May, when we finally peaked out, as we finally got enough acres to ensure we weren't going to run out of soybeans. I kind of think we're in the same pattern this year. We're here. This is November. We're going to continue to push this market higher until we get into the spring. So stay long. If you're not long, get long. Look for pullbacks. This year there was pullbacks. Every year there's pullbacks. Look for those pullbacks to be buying opportunities to establish long positions, until February, March, maybe April of this marketing year. That's my strategy. You can do that with low risk option strategies where you have money invested and you can't lose any more than that. Give us a call. We'll talk you through on how to do some of that. And we just very minor revisions. Ending stocks at 877 million, 6 million less than last year. No change to the cash prices for wheat. Wheat was caught, kind of the tailwinds of corn and soybeans moving higher. If you're a wheat producer, there's some marketing opportunities out there. We want you to take advantage of them on these rallies. Strategies, as we mentioned, no carry in the soybeans. Should sell for fall delivery and re-own. Still think that's a good strategy. There's still no carry. There's still no reason to store soybeans, but you want to maintain ownership through cash and futures, or futures and options. If you have to do it in cash, do it in cash. We suggest futures and options are going to give you more bang for your buck. Retail, retain ownership of corn as well through futures or options or the cash market. We think there's going to be kind of an acreage battle going into the spring, particularly for soybeans. Going to need to buy some of these acres from the farmer. And wheat exports look to be weak in the second half of 2020. We have seen weak exports here. We've been talking about this for several months. I left this on here as I've been thinking we're going to see poor exports. Supply rallies need to be sold, need to be hedged, and we're seeing some type of a supply rally thanks in part to corn and soybeans. Have a good evening. Thanks for your attention, and if you have any questions, as always, give us a call. This has been Brian Hoops for Midwest Markets.